ready to jump right into another form due from C corporation. So we have the foreign corporation, and all foreign corporations are taxed under subchapter C. And then we have domestic corporations that have not elected to be taxed under subchapter S. However, this form, I believe, is also required by an S corporation, but it'd be pretty unusual because you see it's 25% foreign owned. However, the IRS does now have a new rule that lets non-resident treaty member individuals to own an S corporation. But we're going to assume this is just a C corp. And this form is important. The fine for not filing it is $10,000. The name of reporting corporation, that's going to be your domestic corporation that's 25% owned by a foreign person. And engaged in the U.S. business, that's a foreign corporation, Form 1120F, engaged in U.S. treaty business. We're going to get to that next. So we're going to stay in the corporate area for a while before we get to the other returns. And a lot of this stuff is pretty straightforward. Total gross payments on this Form 5472, you may have to do more than one if there's more than one related party. And we're going to get into the gross payments. Country of incorporation, that's important. Where you file an income tax return? Is it only the United States, or you do it more than one country? Not uncommon, especially with a foreign corporation filing a Form 1120F. And once again, we're really looking at voting power. Important to really focus on these words and value, because the two have completely different things. The name and address of the shareholder, that's what you would expect. Citizenship, income tax, where is he an income tax resident? Comes back to treaties. There is a thing called a dual resident, and that's not a topic for this course, but it's something you should be made aware of. Name and address of ultimate indirect 25% shareholder. So this is the case where you have a family person owning the shares for somebody else, and this is very common in many countries, especially those that have been under the economist control, where people have a great fear of their government. Keep in mind, all this information goes to the IRS, and under treaties now, it can go to all these countries. It can go to China, it can go to Russia. So it's scary for some people, and we'll get into trust a little bit towards the end. That's why a lot of people use a trust instead of the individual name. Related party, name and address of the related party. This is the other corporation that you're paying things to. Now, if you don't have any, you just put in none here. So I always file this form for all my clients, and if nothing in here, then I just put in none. But the form always goes out because the fine's $25,000, and quite often the computer just throws out the fine when they see the 25% or more ownership on the Form 1120, when they see that ownership is a foreign person. These type of questions are going to be the same ones, and they're taken from the Form 5471. It's the same things we had on the Form 5471. Same instructions. Amounts borrowed is a little bit different. Before the Form 5471, it was the highest amount. Here, this form's a newer form. It's a little bit smarter, a little bit more looking at the real important things, getting balance, any balance, or a monthly average. So that's quite a different. Same with amounts loaned, and then non-monetary less than full consideration. So this would be bartering type of transactions. And then here's some important questions. Is the basis of, is the tax cost of the goods on the tax return the same as the value reported to customs? So that's important. A lot of people thought they could have different values, and you cannot. The other thing I want you to be aware of is cost sharing again. The IRS really is fearful of cost sharing. They've been forced into it. It's in the regulations. They got forced into it because they lost some court cases. and then they got, which is why they wrote the regs to try to get some control over it, and then they lost another case. So cost sharing is a great way for your tax planning. So once again, on this form, you see where your tax planning can be. Cost sharing. Anything in the questions is a place where you can dot your I's and cross your T's and give some value to your clients. Line 7 here, intangible properties, which is generally what we do, what we see with cost sharing. Shifting the value through in tangible properties by planning the business structure and methods before the business takes off or when it's just beginning provides a great tax savings. So we're going to finish up here. We can do some questions and answers, and then we're going to go over to the Form 1120F, because that's a form that has its own issues. So we'll get to that